A bubble, in a financial sense, is something you're probably familiar with.
It was the worst day on Wall Street since the crash of 1987.
Two of history's biggest bubbles, one in dot-com stocks, the other in the US housing market, both burst in the last 30 years, ushering in periods of recession.
As you are aware, the U.S. economy is undergoing a severe contraction.
Smaller bubbles, like one in Dogecoin, have popped even more recently. And over the past year, many analysts were warning that this market was flashing a red alert. But not so fast.
It's incredibly hard to predict or call a financial markets bubble when you're in it.
So rather than get out the crystal ball, let's turn back the clock to look at what bubbles are, how they burst, and why history keeps repeating itself. A bubble is a market condition created by a rapid surge in the price of an asset to levels that far exceed that asset's fundamental value. Here, it's helpful to think of an asset bubble more like a balloon, where the air inside represents investment, and the size is its value. The balloon has an ideal size, its fundamental value, but it can inflate and deflate as air is put in or pulled out. And investors have ways to track these movements.
So a lot of investors look at a metric like the price to earnings ratio of a stock, which basically measures how much am I paying up for this company's earnings? And is this company worth what I think it is?
Going back in time to the 1600s provides one of the earliest examples of an asset ballooning. At the time, tulip bulbs, especially the ones producing the rarest flowers, were so in demand that they were being purchased on contract before they were even grown. According to 19th century writer Charles Mackay, a single rare bulb could at one point be exchanged for dozens of items combined, including 2 bundles of wheat, 4 oxen, and 12 sheep. Still, people didn't spot the bubble.
One feature of a market bubble is that it tends to kind of pull in so many people, and that makes it incredibly hard to spot it while you're living it because it might make sense at the time.
5,000 shares at 26.
That writer, Mackay, even missed a bubble in his time when the prices of British railway stocks did this in the 1840s. The only real way to know if an asset is ballooning is to wait for it to pop, or rather, deflate rapidly, as seen in 2021 with GameStop.
Well, the GameStop trading craze seems to be slowing down. Shares dropped about 17% yesterday as trading volume dried up.
GameStop provides an example of how bubbles behave, and it roughly follows a 5-stage process economist Hyman Minsky developed in the 1960s to explain credit cycles. The first stage, displacement, when investors start to notice a new pattern emerging in the market. In the case of GameStop, the trend is first seen in online forums, where people start sharing their big wins.
Cheers, everybody!
It drew in people who may not have traded before, who are trading stocks on online brokerages for the first time.
That's stage 2, the boom, when prices start rising as excitement drives new investors into the asset. That's quickly followed by stage 3, euphoria, when prices take off.
There was a sense that, hey, this thing can only go up, even though the company had not changed at all within the span of a few days or a few weeks even.
Which leads into stage 4, profit taking, when some investors begin selling their positions.
All of a sudden, it's not rising anymore. And this momentum trade that you got into is no longer working.
And lastly, panic, when prices drop rapidly and many investors look to get out at any price, often for far less than they bought in.
Some investors I spoke to in the meme stocks in particular were saying that led me to ditch this whole meme stock trade and taught me how dangerous it really was.
So how exactly do bubbles form? There's no single explanation, but in 1996, Federal Reserve Chairman Alan Greenspan coined a term to explain it, and it's been associated with bubbles ever since.
But how do we know when irrational exuberance has unduly escalated asset values?
Greenspan is warning that irrational exuberance on the part of investors can fuel a bubble, and that excitement can stem from a number of factors. A big one, the fear of missing out, or FOMO.
There are few things more powerful than seeing the people around you getting really rich, and that has been a key driver of market bubbles in the past.
Greenspan first spoke of irrational exuberance in the 90s in an attempt to slow a rally in the stock market. But investors kept buying, particularly in hot .com stocks.
I brought something for you from pets.com.
But it wasn't just FOMO that drove investors to ill-fated companies like Pets.com. Another factor was at play ahead of the .com bubble burst: low interest rates.
It's simple math. You have a few different options for where to park your money for returns. And the safest thing possible, government bonds, treasuries, is yielding basically nothing. So what do? You end up going into riskier corners of the market.
At the time, some of the .com companies had no earnings to speak of, but investors saw them as innovative and were willing to bet on future returns.
So bubbles can also form during times of technological or financial innovation, whether it was railroads centuries ago, the internet around the 2000s, or collateralized debt obligations ahead of the Great Recession.
In all of these cases, the bad bets ultimately shook the entire U.S. economy. Both the .com and the U.S. housing bubbles grew so large that following their bursts, the U.S. entered periods of recession.
So even if you weren't investing in internet stocks or mortgage-backed securities, you could still be hit by the fallout from that bubble because unemployment spiked after those bubbles burst.
And interestingly, in times of recession, like the one tied to the COVID-19 pandemic, the Federal Reserve often moves to decrease rates, potentially creating conditions that again drive investors to riskier assets. While some believe this makes bubbles inevitable, it's still incredibly hard to call if and when you're in one.